Should you buy your next investment property in trust or in your personal name? That's exactly what we are answering today. By the end of this video, you will know which structure could save you $60,000 to $120,000 in taxes over the next decade, and which one will cost you more than it's worth. I'm Ash from ClearTax. Over the past 5 years, we have structured property portfolios for 1,200 investors across Victoria, New South Wales, and Queensland. And here's what I have learned sitting with hundreds of property buyers. 60% of the people get this decision wrong. Not because they are careless, but because they followed generic advice that did not match their situation. So, in the next few minutes, I'm going to show you how a trust works, the potential downside you should consider, and finally, I will leave you with a practical 5-question decision framework. Answer these 5 questions and you will know with complete certainty whether a trust is right for your situation before you sign anything. Let's get into it. I will start with the basics. What actually is the trust? Think of a trust like a Tupperware container. You buy an investment property, and instead of putting that into your name, you put it inside a container, which is the trust. You still control what happens to the container. You decide who benefits from it, what's inside, but legally the trust owns the property and not you. Not in the same way a company or person would, because it's simply a legal agreement with a set of rules that outlines who manages the property, who benefits from it, and how it works. Now, there are 3 roles who form part of this agreement. So first one is you have the trustee. This is who controls a trust. In most cases, you will set up a company to act as a trustee. Why a company and not just you personally? Because it creates legal separation. If something goes wrong and you get sued, there is a liability issue to deal with. The company acts as a buffer between you personally and the trust assets. Think of it like this. If the trust is a Tupperware container, the trustee company is the person holding it and you are still in control, but there is a layer of protection. Second, you have the beneficiaries. There are the people who can receive income and benefits from the trust. Usually that's you, your spouse, your adult kids, and sometimes extended family members. The trust can distribute income to any of these people in whatever split you choose each year. That's the tax optimization magic we will talk about in a minute. And the third, the settler. This is primarily the legal formality. Typically, it's established by a lawyer or an accountant who sets up the trust, but they generally do not remain involved afterwards. Now that you understand what a trust is, let me show you the 3 scenarios where trust becomes incredibly powerful. Let's start with the first one. Income flexibility and tax optimization. A trust shines when there is a significant income gap between family members. Let me give you the number so that makes sense. Say you and your spouse both earns more than 200K each year. You have no kids and both work full-time. In this situation, a trust has very limited tax benefits because there is no one to distribute the income to a lower tax rate. But here is when it becomes powerful. One partner earns 200K and the other takes a year off, whether to study, travel, or care for aging parents. Without a trust, rental income and capital gains are locked 50-50. You are paying tax at both of your rates. Even though one of you has no income, with a trust, you can distribute a percentage of the income to a non-working partners while they are in a lower tax bracket. I have a client who managed to save $18,000 in taxes in a single year just because of this method. Now let's say you have a 19-year-old daughter studying medicine. She has no income and still living at home. Instead of you paying tax on $20,000 of rental income at 47%, which is around $9,400, you distribute $18,200 to your daughter, that completely tax-free thanks to a tax-free threshold. You have just given her $18,200 to cover a textbook, living expenses, whatever she needs, and save yourself $8,554 in tax that you would have paid anyway. Now, something to keep in mind here is that a trust cannot park profits. When your property generates income, whether that's a rent, capital gains from the sale, the profit must be distributed to beneficiaries by the end of each financial year. You can't just leave it sitting in the trust like you can with the company. The ATO won't allow it. So it has to go somewhere. Second scenario where the trusts are really powerful is estate planning and wealth transfer. What happens when you want to pass on your property portfolio to your kids? If you own properties in your personal name, you want to transfer them to your children, and you will have to pay up to full market rate stamp duty, which is around 5.5% in Victoria, or $55,000 for $1 million property. You will also have to hand over capital gains tax on the increase in value since you bought the property, which could be hundreds of thousands. But with the family trust, here is what happens. Because the trust owns the property, you can transition control to your children by making them beneficiaries and directors of the trustee company. This means no property title changes hands, no stamp duty, no capital gains tax on transfer. Let me give you an example. One of our clients, let's call him George, built a portfolio of 5 properties over 30 years. His total portfolio was worth 4.2 million, and when he bought them, the cost was sat at 1.8 million. If George tried to transfer those properties to his 2 kids in his personal name, he would have paid 230,000 in stamp duty and 550,000 in capital gains tax. That means the total cost to transfer would be 780,000. That's nearly 800,000 just to pass on the wealth to his own kids. Because George had set up a trust from day one, his kids become director of the trustee company and beneficiaries of the trust. There would be no change of the property ownership, no stamp duty, and no capital gains even triggered. And this brings us to third scenario. Third scenario is asset protection. Asset protection is one of the most talked about benefit of the trust, but is also the most misunderstood. Here is how it actually works. If you are a business owner, doctor, financial advisor, or in any profession that's a high liability risk, a trust with a corporate trustee can protect your investment assets if you are sued personally. Why? Because the trust is a company, not you. And if you are not a primary beneficiary receiving income at the moment, those assets are legally separated from your personal liability. Think of it like this. If someone sues you personally, they can come after your personal assets. But if the trust owns the property, a company controls the trust. There is a legal wall between you and the asset. However, and this is critical, a trust does not protect you in family law. I need to say this clearly because I see people set up a trust thinking it will protect them in a divorce. It won't. If you're going through a separation, family court looks at who controls the asset, not just who legally owns them. If you are the one making decisions about the trust, like appointing beneficiaries or directing distributions, the court can include those assets in a property settlement. So that's something to keep in mind. Now, trusts aren't for everybody. There are generally 3 things you need to consider when deciding whether it is a structure that works for you. You don't benefit from negative gear properties year on year. If you buy a negative gear property where your expenses exceeds your rental income, those losses are trapped in the trust. You can't offset them against your personal salary the way you can when you own the property in your own name. Instead, in the trust, the loss gets carried forward, you receive 0 immediate tax benefit, and the trust must wait until it generates profit in the future to utilize those losses. So if you're relying on negative gearing to reduce your tax bill and improve cash flow right now, your trust is a wrong structure. The second thing you need to think about is land tax. Trusts generally don't receive the same land tax-free threshold as individuals. This also varies massively by state. In Victoria, for example, individuals have a threshold of 50,000 land value, which is very low, and most investors pay land tax. The trust threshold is 25k value, which is even lower. In comparison, Queensland has an individual threshold of 600,000 total land value, and trust threshold value is 350k per trust. Now, some might see this as a good strategic opportunity. For example, if you own 5 properties in Queensland with a total land value of up to 1.5 million in your personal name, you are looking at about $12,000 to $15,000 in annual land tax. If you own those same 5 properties across 5 separate trusts and each property's land value is under 350k, you could pay zero in land tax. But in states like New South Wales, trust gets hammered with land tax because of the thresholds are much lower. The point is, you must run the numbers of your state and your portfolio before deciding. And last thing you will need to consider is the setup and ongoing cost. Setting up a family trust properly costs anywhere from $2,000 to $2,500, which includes trust deed, corporate trustee, ASIC registration, and some initial tax and legal advice. Then every year you are paying an ASIC annual company fee and an accountant to submit a separate tax returns, which gets more expensive depending on complexity. You will also need to factor in cost for additional compliance and bookkeeping. If your property is only generating between $5,000 to $8,000 in rental income per year, these costs could eat up most of any tax benefits. So you need to think long term. Trust works best when you are building a portfolio, not just buying one property. Based on these potential downsides, I want to give you 5 questions that will help you decide whether a trust is right for you. Question 1. Do you have a significant income gap in your household? If one partner earns significantly more, and if one of you plans to take time off from work in next 5 to 10 years, a trust can be a powerful asset. Question 2. Do you have adult children who can receive distribution? If your kids are 18 or older and studying or working part-time, you can distribute income to them at lower tax rate. Question 3. Are you building a portfolio or buying one property? Trust makes sense for portfolio if you are only looking at buying one property. That setup and ongoing cost might outweigh the benefits. And question 4. Do you need immediate negative gearing benefits for cash flow? If yes, trust might not be right for you. If your property is positive geared or closer to neutral, a trust works well. Lastly but not the least, question 5. What's your long-term exit strategy? If you are thinking about passing wealth to a next generation, trust offers massive advantages. But if you are planning to sell everything in 10 years and retire overseas, maybe not. Once you have answers to those questions, I would advise you to take it one step further and sit down with 3 people: a property-focused accountant who specialize in tax structures, a mortgage broker who understands trust lending, and a lawyer if your situation involves asset protection or estate planning complexity. Then run the numbers and model different scenarios. Remember to look at both your 5-year and 10-year plans in the process. And whatever you do, don't use a cheap 500 online template to set up your trust. I've seen disasters where the trust deed wasn't drafted correctly, beneficiaries weren't defined properly, and the trustee structures wasn't compliant. Fixing those mistakes cost way more than doing it right the first time. On top of that, a trust is a structure, not a shortcut. When done right, it can save you tens of thousands in taxes and set your family up for generational wealth. But if it is done wrong, it's an expensive anchor that limits your options. If you want to see if a trust fits your specific situation, book a free 30 minutes consultation with our team at ClearTax. Click the link in the description to get started. Thanks for watching. I'll see you in the next one.